So picture yourself standing in the checkout aisle, right? You're at your local grocery store.
Oh, yeah. The classic impulse buy zone.
Exactly. You're just standing there staring at the candy rack. It's right next to, the gossip magazines and that pack of gum you always debate buying at the last second.
Right.
And you reach for a peanut butter cup. It's something you've bought, literally 100 times before. Only this time you notice two very distinct things.
Okay, what are they?
First, the package feels just a tiny bit lighter in your hand, like barely noticeable, but it's there.
Inflation, yeah.
Yeah, exactly. And second, the price tag staring back at you is just undeniably higher than it was, say, a year ago.
It's a rough realization.
It really is. So you pause, you weigh the cost against the craving, and maybe for the first time in a long time, you actually put the candy back on the rack and just push your cart out the door.
Which is happening a lot more lately.
Right. And if you multiply that tiny isolated moment of consumer hesitation by millions of shoppers across the entire country, you arrive at the central mystery we are unpacking in today's Deep Dive.
It's a fascinating mystery, too.
Welcome, everyone, to this Talk Ticker's Deep Dive. Because the company that makes that peanut butter cup, the Hershey Company, ticker symbol HSY, they just reported a staggering, jaw-dropping 57% jump in their earnings per share.
57%? That's massive.
It is. Their profits are absolutely skyrocketing. But, and here's the catch, beneath the surface of that massive Wall Street victory, everyday consumers are physically buying fewer of their products.
Yeah, the volume is actually down.
Which means the math feels completely broken.
Right.
Like, we are taught this very intuitive rule of retail physics. You sell more things, you make more money.
Exactly. It's the lemonade stand model.
Yes. You pour more cups at the lemonade stand, your little cigar box gets heavier with quarters. But here, the volume of lemonade being poured is dropping, yet the cigar box is just overflowing.
Right. And that disconnect between consumer behavior and corporate profitability, that is basically the defining tension in the consumer packaged goods sector right now.
The CPG world is just wild right now.
It really is. It completely breaks the fundamental logic we usually rely on to understand, market health.
Yeah.
When a company reports a 57% earnings jump, your immediate assumption is, well, they must be capturing massive amounts of new market share.
Right. You assume they're just moving millions of extra units off the shelf.
Exactly. But what we are actually looking at with Hershey's Q2 2026 earnings call is just a masterclass in financial leverage.
Like, how so?
Well, it is a very raw, very transparent demonstration of how extreme corporate pricing power can temporarily defy the laws of consumer gravity, so to speak.
Oh, wow. Defying gravity. I like that.
Yeah. But to really grasp the gravity of the numbers they just reported, we kind of have to establish the defensive posture Hershey was in as they entered 2026.
Right. Because they weren't exactly riding high, were they?
Not at all. This was a legacy company with its back slightly against the wall. The market was looking at them with a lot of skepticism. They entered this year needing to prove they could orchestrate a really meaningful recovery in their margins.
And they had to do all of this turnaround work while navigating a consumer base that is, frankly, exhausting.
Oh, completely. Yeah. Highly cautious, financially stretched by just years of cumulative inflation. Yeah. Not to mention, increasingly influenced by rapidly evolving health and wellness trends.
So the stakes for this specific second quarter earnings call were essentially existential for them.
Yeah, they really needed to show Wall Street that they still completely controlled that checkout aisle.
Okay, so let's tear into the absolute core financial results then, the headline numbers.
Let's do it.
Because when analyzing any earnings call for a Talk Tickers breakdown, the top line is where we always build our foundation, right? It tells us if the narrative is a beat, a miss, or maybe just a clever accounting illusion.
Right, you got to start with the top line.
So Hershey reported that their Q2 net sales increased 6.6% year over year.
Which on its own, a 6.6% increase for a mature century-old candy company, that's really solid.
Yeah, it definitely outpaces general economic growth. But a single-digit sales increase, it doesn't really explain the fireworks on the bottom line.
No, it doesn't at all.
Right, because the absolute blockbuster metric from this call is that their adjusted earnings per share, their EPS skyrocketed by 57% to land at $1.90 for the quarter.
Just an incredible jump.
And the driver behind that EPS explosion, it's their adjusted gross margin, which expanded by a massive 350 basis points.
Okay, we really have to unpack the mechanics of that gross margin expansion right there.
Please do, because 350 basis points sounds impressive, but what does it actually mean?
Well, it's a number that literally forces analysts to recalibrate their spreadsheets. So in the financial sector, a basis point is simply 1/100th of a percentage point. So an expansion of 350 basis points means Hershey's gross margin increased by 3.5 full percentage points compared to the exact same quarter last year.
Right, so 3.5% more margin.
Exactly. To make that tangible for you, for every single dollar of revenue Hershey pulls in at that checkout aisle, they are keeping 3.5 cents more in gross profit today than they were 12 months ago.
Okay, wait. 3.5 cents. In the context of my personal finance, that is completely meaningless.
Oh, yeah. It's the lint-covered change at the bottom of your cup holder.
Exactly. But for them...
But in the consumer packaged goods industry, the CPG world companies will literally fight brutal, bloody wars over fractions of a single penny.
Really? Just fractions?
Oh, absolutely.
Yeah.
They will spend millions optimizing the thickness of the cardboard in their shipping boxes just to find 1/10 of a cent in savings.
Wow. Okay, so finding 3.5 whole cents is huge.
It's an operational earthquake. Suddenly materializing 3.5 cents of pure profit margin on every single dollar across billions of dollars in global revenue. It indicates a massive systemic shift in how the company is pricing its goods relative to what it actually costs to produce them.
Which instantly triggers my alarm bells as a consumer, I gotta be honest.
Right, because of where that margin is coming from.
Yeah. I mean, if a company is suddenly extracting that much more profit out of every single dollar they take in, and we know they haven't fundamentally reinvented the underlying product.
A chocolate bar is still a chocolate bar.
Exactly. The math suggests they are just aggressively squeezing the consumer. I mean, they haven't found some magical new way to harvest cocoa for free, right?
No, unfortunately not.
So they're just charging us significantly more for the exact same amount of sugar and cocoa, padding their bottom line while kind of banking on our brand loyalty to blind us to the price hike.
You're completely right. The mechanism driving that 350 basis point margin expansion is almost entirely built on the consumer's back.
So they really are squeezing the checkout aisle.
They are. And that brings us to the actual structural mechanics of how Hershey engineered these Q2 numbers. It is a highly deliberate, very high wire balancing act between pricing power and physical volume.
It sounds risky.
It is. The company is actively testing the threshold of consumer pain.
Okay, let's break down that tension then. Because peeling back the layers of that 6.6% top-line sales growth reveals this massive underlying tug of war.
Yeah, the total revenue went up, but how it went up is the real story of the quarter here.
So let's get into the price versus volume math.
Right. The sheer extremity of the price versus volume dynamic in this report is what makes it such a critical case study for investors. In the second quarter, Hershey's net price realization was up approximately 12%.
Meaning they hiked prices across the board.
Exactly. Across their entire portfolio of products, they raised prices by an average of 12%.
Wow. And how did people react?
Well, in response to that aggressive pricing action, their volume-like, the actual physical tonnage of product rolling out of their factories and into shopping carts declined by approximately 8%.
Let me just repeat that so it sinks in. They jacked up the price tag by 12%, and the public reacted by buying 8% fewer physical items.
You got it.
So the revenue only goes up simply because the 12% price increase outpaced the 8% drop in physical sales.
Exactly. And the technical term for this behavioral response is elasticity.
Elasticity.
Hey, it's basically the Wall Street metric for consumer pushback. Think of a consumer's willingness to buy a product as a rubber band.
Okay, I'm picturing it.
When a company raises prices, they are stretching that rubber band. The elasticity measures how violently the demand snaps back and shrinks as the price goes up.
And Hershey really stretched it this quarter.
Oh, they stretched that rubber band further than they have in recent memory. Yeah. They aggressively raised prices to shield their own profit margins from the inflation they were experiencing in raw materials and labor.
Right, because cocoa prices have been crazy.
Exactly. And the American consumer absorbed a significant portion of that blow, but they didn't absorb it passively.
No, they fought back.
Right. The elasticity metric proves that consumers stood in the grocery aisle, looked at the newly inflated price of a multi-pack of candy, and made a conscious behavioral shift.
They decided to just buy one bag instead of two.
Exactly. Or they decided to buy a smaller pack. Or, honestly, they just skipped the candy aisle entirely.
So that 8% drop in volume is literally the physical manifestation of consumer exhaustion.
Beautifully put, yes. But mathematically, because the 12% price hike was a larger integer than the 8% volume contraction, top-line revenue still prints as a positive number.
Man, it just feels like an incredibly dangerous game of chicken.
It really is.
Like, how far can you stretch the rubber band before it completely snaps? Because if you look at the segment data, that rubber band is looking terrifyingly frayed in certain places.
Oh, absolutely. Let's isolate their crown jewel division, for example.
Yeah, right. The North America confectionery, the core candy business.
Exactly.
The reported net sales for this segment rose 4.2%. But the physical volume, the actual amount of chocolate moving out the door, crashed by 10%.
A 10% volume crash.
Right, a double-digit decline in physical product movement. I mean, that is usually a disaster siren for a CPG brand, isn't it?
Normally, yes. Manic mode.
And management pointed to that elasticity we just discussed, along with some vague shipment timing dynamics. But if the physical volume of candy being purchased by end consumers dropped by a massive 10%, a 4.2% rise in sales revenue feels entirely artificially propped up.
It is propped up. And when you dig into the transcript, management actually admits that retailer inventory replenishment is what saved the segment's revenue numbers.
Okay, what exactly is retailer inventory replenishment?
So the mechanics of retailer inventory replenishment are really crucial to understanding why Hershey's numbers look so good on paper while the actual consumer is pulling back.
Walk us through it.
We have to look at the supply chain from the perspective of a grocery store manager.
Okay, I'm a grocery store manager.
Right. In the previous quarters, as Hershey was rolling out these price hikes and consumers were starting to balk, retailers got incredibly nervous. A store manager's worst nightmare is being stuck with a backroom full of expensive, perishable inventory that just isn't moving.
Makes sense. You don't want melting chocolate in the back.
Exactly.
Oh.
So these retailers engaged in destocking.
Yeah.
They intentionally let their on-hand inventory levels drop way below historical averages just to protect their own cash flow.
Okay.
But that defensive strategy has a hard limit. Eventually, you have to put products on the shelves.
Right. You cannot run a major supermarket with empty end caps where the Hershey bars are supposed to be.
Precisely. Your baseline inventory requires a minimum threshold of product just to make the store look fully stocked and operational.
Ah, I see. So in Q2, these grocery chains were essentially forced to place massive bulk orders with Hershey simply to rebuild their baseline shelf presence. And that's completely independent of how fast the consumer was actually buying the candy at the front register.
That is the exact mechanism right there. The massive wave of bulk purchasing by retailers artificially inflated Hershey's Q2 sales data.
So it's like a buffer.
Yeah, it acts as a buffer, completely masking the sluggish reality of the end consumer demand. The retailers were replenishing their backrooms, which registers as a completed sale on Hershey's balance sheet.
But the true test is the sell-through rate, right?
Exactly. If that inventory is just sitting on the retail shelf because the consumer is still rejecting the 12% price hike, the grocery stores will not place another massive order in Q3.
They'll just sit on what they have.
Right. The replenishment bump is just a one-time accounting grace period.
Which means they might just be borrowing sales from the future.
Yes.
Wow. If the shelves are full but the shopping carts are empty, Q3 could see a violent correction in order volume.
It's a very real risk.
And that level of vulnerability in the candy division kind of explains why Hershey has been so desperate to diversify lately.
Oh, absolutely. Which brings us to the North America salty snacks segment.
Yes, let's talk about the salty snacks, because on the surface, the headline number here is clearly designed to elicit a standing ovation.
It looks amazing at first glance.
Reported net sales for salty snacks surged 22.9%. If you were just skimming the press release, you think, wow, Hershey has cracked the code on savory snacks.
Right, almost 23% growth.
But the underlying data tells a wildly different story. Out of that 22.9% growth, a staggering 22 points came directly from an acquisition.
Yeah, they recently purchased a brand called Lesser Evil.
Right. So if you strip away the revenue from the company they just bought, their organic, constant currency volume growth for salty snacks was a lethargic 3%.
It's just a huge discrepancy. And this reliance on acquisitions to mask internal stagnation. It's a classic corporate maneuver.
Is it common?
Very common. It requires a strict division in how we evaluate the data as analysts. Inorganic growth versus organic growth.
Break that down for us.
So inorganic growth is the revenue you simply purchase. If a company has enough capital, They can acquire a fast-growing startup, bolt that startup's revenue onto their own balance sheet, and instantly show Wall Street a massive double-digit growth spike.
And it looks fantastic in a headline.
It really does,
Yeah.
but it completely obscures the operational health of the core pre-existing business.
Right, because organic growth is different.
Exactly. Organic growth isolates how well your legacy products are performing without the artificial injection of acquired revenue. It's the true unfiltered pulse of a company's market traction.
So a 3% organic growth rate in a salty snack division that was explicitly designed to be Hershey's high-growth engine that is deeply underwhelming.
Very underwhelming, especially considering the broader cultural shift towards snacking right now.
Yeah, because they didn't buy Lesser Evil by accident, did they?
No, not at all. Lesser Evil is a premium, better-for-you popcorn brand.
Right.
It signals that Hershey is acutely aware that consumer preferences are moving away from heavily processed, high-sugar legacy candies and moving towards snacks perceived as cleaner or, functional.
But just bolting a healthy popcorn brand onto the balance sheet doesn't fix the operational issues plaguing their existing snack portfolio.
Exactly. And the transcript was surprisingly blunt about this, actually.
Yeah, management straight up admitted that the salty snacks division severely missed their internal expectations.
They didn't try sugarcoating it, pun intended.
Huh, nice. And the root cause wasn't even a lack of consumer interest. It was catastrophic supply constraints.
Yeah, this is where it gets frustrating.
They specifically cited an inability to manufacture enough multipacks and significant supply chain breakdowns with Dot's Pretzels, which is supposed to be the absolute crown jewel of their savory division.
The supply chain failures surrounding Dot's Pretzels are a severe unforced error.
Why is it an unforced error?
Because as an analyst, you evaluate lost sales differently depending on the cause. Like if you lose sales because consumers suddenly hate your product, okay, you have a brand crisis.
Right, that's a marketing problem.
Exactly. But losing sales because consumers are actively demanding your product, literally sweeping it off the shelves as fast as they can find it, and your manufacturing infrastructure simply cannot produce and package it fast enough.
That's just leaving money on the table?
It is pure operational incompetence. Dot's Pretzels are wildly popular right now. They have immense momentum.
Yeah, they're everywhere.
But failing to capitalize on that momentum because of factory bottlenecks or packaging shortages is leaving millions of dollars of easy revenue behind.
And the specific mention of multi-pack constraints highlights a common vulnerability in CPG manufacturing, right?
Yes, because producing the actual pretzel is only half the battle.
You actually have to bag it.
Right.
Yeah.
If the machinery required to pour in those pretzels into smaller individual bags for, say, school lunches or variety packs breaks down or lacks capacity, the entire revenue stream just halts.
Regardless of how much raw product you have sitting in the vats.
Exactly.
Yeah.
You could have a mountain of pretzels, but if you can't bag them, you can't sell them.
And when a company starts struggling with basic logistics like that, you really start seeing the impact on the margins.
Oh, definitely.
Which makes a tiny detail buried in the transcript so fascinating to me. The only reason the margins in this segment didn't look substantially worse is because Hershey benefited from a one-time $9 million tariff refund.
Yeah, that stood out to me too.
The government basically handed them a check, and management openly admitted they used that refund to offset unfavorable freight and logistics costs.
Which is a huge red flag. We have to aggressively discount one-off accounting benefits like tariff refunds when projecting a company's future health.
Because it's not repeatable.
Right. A tariff refund is just a bureaucratic windfall. It is a reversal of a previous penalty or a reclassification of imported materials by customs authorities. It provides a sudden injection of cash, sure, but it has absolutely zero bearing on the company's ability to efficiently transport goods in the future.
So the fact that Hershey had to point to a random government rebate to explain how they managed the severe inflation in freight and shipping costs, that tells you that their underlying logistics network is operating under extreme financial pressure.
Completely. You cannot build a sustainable long-term business model hoping the government periodically refunds your import taxes just to cover your trucking bill.
No, you definitely cannot. It's the definition of a low-quality earnings beat.
Exactly.
The structural problems in domestic shipping are real and ongoing. Now, looking globally, there was one area where the pricing power strategy seemed to execute flawlessly.
The international segment.
Right. It outperformed expectations, with Q2 net sales up 5.7%. And the data specifically highlighted a massive 7.5% net price navigation bump that management has been compounding since late 2019.
So they're pushing the price envelope overseas and finding significantly less resistance than they are at home.
Yeah, which is interesting. But we really have to return to the U.S. consumer environment, because management's commentary on domestic shoppers was incredibly revealing.
Very revealing.
They repeatedly described U.S. consumer sentiment as soft and heavily value-oriented.
And we need to translate that.
Please do.
Because the term value-oriented is highly sanitized corporate language.
Right. It sounds nice on a conference call.
Exactly. But when a CPG executive uses that phrase, what they actually mean is, our customers are financially exhausted, hypersensitive to price tags, and actively hunting for generic or cheaper alternatives.
They are tapped out.
Completely. The U.S. consumer has been battered by compounding inflation across unavoidable household expenses. I'm talking housing, insurance, utilities, auto loans.
Right, all the non-negotiables.
Right. So by the time that consumer reaches the snack aisle, their discretionary budget is just decimated. They are making ruthless, calculated trade-offs.
They are no longer throwing impulse items into the cart without looking at the price.
Not anymore, no.
But the nuance here is what's really fascinating, because the transcript notes that despite this value-oriented mindset, changes to the SNAP program, the Supplemental Nutrition Assistance Program, had only a very modest impact on household spending in Hershey's specific categories.
Yeah, that surprised a lot of analysts.
Right, because there was widespread fear across the food industry that reductions in SNAP benefits would completely annihilate snack food sales. But Hershey's chocolate and pretzels seem strangely insulated from that specific budgetary shock.
It is strange.
Why would a financially stressed demographic prioritize premium chocolate?
Well, you are looking at a classic economic phenomenon known as the lipstick effect. And it's heavily concentrated in the grocery aisle right now.
The lipstick effect. Okay, I've heard of this.
Yeah. The lipstick effect theorizes that during periods of economic distress, when consumers are forced to abandon large, aspirational purchases,
like buying a new car or taking a family vacation.
Right, or upgrading a home.
Okay.
When they have to abandon those, they aggressively console themselves with small, highly accessible luxury goods.
Ah, so a $3 premium chocolate bar or a $6 bag of gourmet popcorn functions as an affordable indulgence.
Precisely. It provides a brief psychological escape from financial anxiety. Even when household budgets are slashed, consumers fiercely protect these micro-luxuries because removing them entirely makes the austerity feel almost unbearable.
That makes so much sense. And Hershey clearly relies on this psychological mechanic.
Oh, they bet the house on it. They know that a peanut butter cup is often the cheapest form of stress relief available to the American worker.
Wow. Okay, so we have a really complex landscape here.
Very complex.
Let's recap. Physical volume is dropping by 8%. Supply chains for key growth drivers like Dot's Pretzels are bottlenecked. The domestic consumer is financially exhausted.
Right.
Yet through brute force price hikes, inorganic M&A growth from lesser evil, and psychological reliance on the lipstick effect, Hershey is generating astronomical profit margins and immense amounts of cash.
It's quite the paradox.
It really is. So the defining question for anyone analyzing this stock is, what is management going to do with this massive war chest in the back half of 2026?
And this pivots our analysis directly into management guidance, because past performance data only tells you how a company survived the previous 90 days.
Right. Looking backward.
Exactly.
Huh.
Forward guidance is the definitive roadmap for how they intend to allocate capital and attack the future.
And the guidance section of this call is where the narrative gets truly aggressive.
Oh, it really does.
Because despite acknowledging the soft consumer and the massive drop in physical volume we just talked about, management is projecting bulletproof confidence.
Yeah, they didn't flinch.
No. They didn't just reaffirm their previous targets, they actively narrowed their full-year net sales and adjusted EPS ranges to the absolute top half of their prior outlook.
That is a bold move.
They are planting their flag, officially expecting full-year organic net sales growth to land between 3% and 3.5%. Furthermore, they expect the historic gross margin expansion we dissected earlier to hold steady, settling slightly below 400 basis points for the entire year.
Incredible.
And they also explicitly flagged that the third quarter, the one we are currently navigating, is projected to be their strongest quarter of the entire year for earnings per share growth.
Okay, we actually need to pause right here and address a highly specific data anomaly in the raw transcript regarding that full-year EPS guidance.
Oh, right. I know what you're talking about.
Because it perfectly illustrates the dangers of relying on automated financial data parsing.
Yes. Tell them what happened.
So if you read the raw machine-generated transcript of this call, there is a moment where the CFO is quoted as expecting full-year EPS to land in the upper half at $32.05.
Which is insane.
Right, we have to immediately flag that as a transcription hallucination. An earnings per share of $32.50 for the Hershey Company is mathematically impossible based on their historical revenue generation, current operating margins, and outstanding share count.
Right. It would mean they essentially became like Apple overnight.
Exactly. It would represent a completely absurd, logic-defying spike in profitability. What we are seeing there is just an AI transcription error misinterpreting spoken financial shorthand or maybe internal metric phrasing.
But the underlying message is still clear.
Yes, our job is to extract the intent behind the glitch. The core message management was delivering, regardless of how the algorithm garbled the specific digits, is that they are boldly and definitively committing to upper-tier earnings performance.
They are looking Wall Street analysts in the eye and stating that they will not just meet expectations, they are engineered to hit the absolute ceiling of their previously stated ranges. It is a critical reminder for everyone listening that you have to stress test the raw data against the historical reality of the business. You just cannot blindly plug machine-generated numbers into a valuation model.
Never. You'll end up buying or selling for completely fabricated reasons.
Right. Now, moving past the targets, let's examine how they're actually deploying the cash they are generating. Because they are well aware of the 8% volume drop.
They know it's a problem.
And they know that infinite price hikes are mathematically unsustainable. You eventually have to convince the public to physically buy more items.
Right. The rubber band can only stretch so far.
Exactly. So to combat this, Hershey is unleashing a massive 30% year-over-year increase in brand investment in the second half of the year.
30% is a massive jump in marketing spend.
It is. They are flooding the zone with marketing capital to support initiatives not just for the upcoming Halloween season, but laying the groundwork for 2027.
The 30% spike in brand investment is basically the necessary countermeasure to the elasticity problem.
Oh.
Well, when you raise prices by 12% and lose 8% of your volume, you have successfully defended your margins, sure, but you have alienated a segment of your customer base.
Right, people are annoyed.
Exactly. So to win them back, or to convince remaining customers to increase their purchase frequency, you have to overwhelm them with marketing and product innovation.
You have to manufacture new reasons for them to reach for your product.
Exactly.
And the specific product pipeline they detailed is perfectly engineered to trigger those impulse purchases. They are heavily promoting Hershey's Creme-Filled bars, which management elevated as a major flagship offering.
Right.
But the real headline grabber is the launch of Reese's Pieces with Cookie.
Oh, man.
They are stuffing cookies inside peanut butter, inside a candy shell. It is the culinary equivalent of a maximalist fever dream.
It is a highly engineered, calorie-dense margin driver. That's what it is.
You're true.
And honestly, it is a brilliant tactical play.
Why is that?
Because when consumers are highly sensitive to the base price of a standard chocolate bar, it becomes very difficult to justify further price increases on legacy items. You can't just keep raising the price of a regular Reese's cup.
Right. People know what that should cost.
Exactly. But when you introduce a completely novel, complex product like a cookie-stuffed Reese's Pieces, you completely reset the consumer's internal price anchor.
Because they have nothing to compare it to.
Exactly. The shopper has no historical reference point for what a cookie-stuffed Reese's should cost.
That's sneaky.
It's very smart. Therefore, Hershey can launch this new innovation at a significantly higher premium price point, generating massive margins, while utilizing that 30% increase in marketing spend to convince the consumer that the novel experience completely justifies the cost.
It bypasses the fatigue associated with inflation on everyday items.
Perfectly.
Wow. So they are essentially designing their way out of the pricing trap.
They are.
But marketing cookie-stuffed candy is only one facet of their capital allocation strategy. The most aggressive moves are happening in how they are returning value directly to the shareholders.
This is where the cash flow really flexes.
The sheer volume of cash they are distributing is staggering. In the second quarter alone, Hershey paid out $286 million in dividends, representing a 6% increase year over year.
$286 million.
Yeah. And alongside those dividends, they executed $370 million in share repurchases in just a single 3-month window.
Wow.
And to accelerate that momentum even further, the board of directors just approved a brand new, massive $500 million share repurchase authorization in June of 2026.
Okay, the combination of raising financial guidance to the top half of expectations while simultaneously executing hundreds of millions of dollars in stock buybacks, that is the ultimate display of corporate swagger.
Corporate swagger. I love that.
It really is. We need to dissect the mechanics of a share repurchase program, though, to understand why it is such a powerful signal to the market.
Yeah, please break down buybacks for the listeners.
Sure. When a company uses its cash reserves to buy its own stock on the open market, it essentially retires those shares. It permanently removes them from circulation.
Right.
This triggers 2 massive effects. First, it is pure financial engineering designed to boost the earnings per share metric.
How does it boost EPS?
Well, if the company generates the exact same amount of net income, but that income is now divided among a smaller pool of existing shares, the profit assigned to each individual share automatically increases.
Oh, I see.
Yeah, you're making the pie slices bigger by simply removing people from the table.
That makes sense. I kind of look at it like a professional sports team retiring a player's jersey.
Okay, I like that analogy.
Like, the team doesn't actually get any better on the field, but the remaining active jerseys suddenly feel slightly more rare and valuable to the collectors.
Exactly. The underlying fundamentals of the business haven't changed, but the math dictating the value of a single share has been artificially compressed in the investor's favor. That is an excellent way to conceptualize the math. But the second effect of a massive buyback program is psychological.
The swagger part.
Exactly. It is a definitive signal sent directly from the board of directors to the broader market.
What are they signaling?
By authorizing $500 million in buybacks, the board is stating unequivocally that they have evaluated all potential external investments, like new factories, new acquisitions, new R&D.
Right.
And they've concluded that the single greatest return on investment available in the global economy right now is their own undervalued stock.
They're betting on themselves.
With maximum leverage. It is a profound statement of confidence in the durability of their cash flow, regardless of what the macroeconomic environment throws at them.
Which brings us to the crucible of this analysis. We have mapped out the entire battlefield.
We have.
Let's summarize one last time. We have a company experiencing an 8% contraction in the physical volume of goods sold. They are battling a highly cautious, economically battered, value-oriented consumer base. They are fumbling the supply chain logistics on their fastest-growing pretzel brand and relying on government tariff refunds to blunt logistics costs.
Yep.
Yet, simultaneously, through sheer brute force pricing power, they are expanding their profit margins by historic 350 basis point levels. They are acquiring their way to top-line growth with brands like Lesser Evil. They are dumping a 30% increase into aggressive marketing, and they are generating such an absurd surplus of cash that they can casually raise their dividend and buy back $500 million of their own stock.
The contradictions are dizzying.
They really are. So it is time for the final Talk Tickers verdict. Based on this complex matrix of data, as an investor looking at the Hershey Company today, are we taking a bullish or bearish stance?
Well, the verdict requires segmenting the audience, honestly, because this stock behaves very differently depending on your personal investment philosophy.
Okay, let's start with the bull case.
For a specific class of investor, I am taking a very strong, unapologetically bullish stance.
Who is that for?
If you are a dividend growth investor, or a traditional value investor who prioritizes fortress-like cash flow, capital return, and defensive stability, Hershey is executing a masterclass right now.
Because of the margins.
Yes. Management is running a price over volume playbook to absolute perfection. The ability to expand gross margins by 350 basis points in an environment where consumers are actively hunting for discounts is proof of an almost impenetrable economic moat.
Right. People simply refuse to give up their Hershey brands entirely.
Exactly. The company has demonstrated that they possess the pricing power to ruthlessly protect their bottom line, shielding their profitability from raw material inflation and supply chain friction.
So it's a safe haven.
If you want a resilient cash cow business that will consistently hike its dividend and artificially prop up its share price through massive buybacks, Hershey is a premier asset.
I understand the mechanics of the bull case. The cash flow is definitely undeniable. But prioritizing price over volume is a strategy with a definitive expiration date.
It absolutely is.
I'm looking at that 8% volume drop, and I am seeing a massive structural vulnerability.
And that leads directly to the bearish caveat. This is a severe warning for growth-oriented investors.
Right, if you want explosive growth.
If you are buying a stock expecting rapid, explosive market share expansion and organic dominance, you must look elsewhere. That 8% drop in physical volume is a bright, flashing red light on the dashboard.
Because there is a limit.
There is an absolute mathematical ceiling to pricing power. You cannot infinitely squeeze the American consumer to manufacture margin expansion.
They'll just stop buying.
Right. If Hershey continues to rely on price hikes to pad their earnings, cost-conscious consumers will eventually hit their absolute breaking point.
The rubber band snaps.
Yes. The cross-price elasticity will trigger, and shoppers will aggressively trade down to private label brands. They will completely abandon the premium nameplate and start buying the generic store brand peanut butter cups.
And the supply chain stuff doesn't help either.
Not at all. The operational incompetence regarding the supply constraints on high-growth assets like Dot's Pretzels must be resolved immediately. You cannot afford to fumble the manufacturing logistics on your most popular new items when your legacy candy volume is shrinking.
You have to capture every single dollar of demand available in your growth divisions.
Exactly.
So to synthesize the data into a final actionable framework for you, if you already hold the stock in your portfolio, the data suggests you should hold your position, sit back, and enjoy the aggressive capital returns.
Please collect the checks.
Right. The dividend hikes and the massive share buybacks mean the company is actively utilizing its massive cash flow to make you richer, even as physical sales slow down.
Agreed.
But if you are on the sidelines considering buying the stock today, you must accept the reality of the asset. You are buying into a highly profitable, historically significant company with unmatched monopolistic pricing power in the checkout aisle. But you must be able to stomach the reality of flatlining or even continually shrinking physical sales volume. You are paying for margin efficiency and financial engineering, not organic market share expansion.
That is the exact distinction. It is a pure profitability and capital return play, not a fundamental growth story.
Right.
As long as you align your expectations with that reality, the mechanics of how management extracted profit from this challenging quarter were incredibly impressive from a purely financial standpoint.
And that comprehensive breakdown wraps up our core analysis for today. We hope this deep dive helped translate the dense Wall Street jargon into a clearer picture of how consumer mechanics actually drive corporate valuation.
It's all connected.
It really is. We hope mechanics of elasticity, margin expansion, and inventory replenishment make a bit more sense the next time you look at a quarterly earnings report.
But before we go,
Yes, before we close the book on Hershey, we want to leave you with one final lingering thought.
it's something we spotted briefly in the management commentary.
Right, and it connects all the way back to the tension we explored at the very beginning of this conversation. The fundamental tension between the math of selling snacks and the physical reality of consumer behavior.
So during the Q&A portion of the call, management very casually noted that the adoption of GLP-1 weight loss drugs.
The pharmaceuticals like Ozempic and Wegovy that are just sweeping the nation right now.
Exactly. They noted that the adoption of these drugs is currently tracking, quote, in line with expectations.
Which is a huge statement.
It is. And crucially, they tied this observation directly to their new strategic M&A pivot toward permissible and functional snacking.
This is the exact philosophy driving their acquisition of brands like Lesser Evil Popcorn.
And their exploration of high-protein alternatives.
Right. So consider the long-term implications of that statement. At the top of the show, we analyzed how strange it is that Hershey is generating record profits while consumers are physically buying 8% less volume. Right now, in 2026, we know that lower volume is driven almost entirely by economic elasticity. People are financially exhausted and tired of 12% price hikes.
But what happens if America's fundamental relationship with snacking changes over the next decade?
Exactly. Not because of inflation, not because of supply chain constraints, but because of a pharmaceutical revolution that acts as a nationwide neurological appetite suppressant.
Is a wild thing to think about.
If the volume of chocolate sold drops not because people cannot afford a candy bar, but because the chemical receptors in their brains physically no longer crave sugar, the entire legacy business model fractures.
It completely changes the game.
Can these new, healthier, permissible acquisitions, like a premium popcorn brand, truly scale fast enough to carry the immense financial weight and margin expectations of a century-old chocolate empire?
That is the ultimate existential question of corporate evolution for them.
It is. And as you watch this stock over the coming years, it is the one underlying metric you must keep a very close eye on. Thanks for joining us on this Talk Tickers Deep Dive, and we'll catch you next time.